girlfriend and saying, I guess I never realized how non-essential you are. So anybody actually worked from home, maybe done a Zoom call, can appreciate this. And I think, from a more serious perspective, to me at least, it makes me appreciate and really honor those individuals there who are essential workers and have been out there since the beginning of this, in some cases, risking their lives to help us and from a healthcare perspective to save lives. So really, thanks to all those folks who do that. So we'll kind of just go through from a market perspective, like we always do, and talk about performance, both the quarter and year to date. And as you can see, the third quarter was really a strong performance compared to any other quarters, historically speaking, with domestic large cap being up 9.5% and similar performance from emerging markets and all the major asset classes having a positive quarter. Year to date, a little bit more of a mixed bag. Large cap still positive for the year. Not listed here is the NASDAQ in our holding QQQ, which was year to date at the end of the third quarter was up almost 30%. And then, but you still have some negative performance from small cap and international, but not surprisingly, U.S. bonds are doing quite well year to date, with in particular because rates have dropped so dramatically. And we kind of just go through, and we talk about this every time on the webinar. And this hasn't changed too much, but just as a reminder from a tactical perspective, how we have the portfolio positioned. So right now we continue to be overweight U.S. equities, technology, low volatility, dividend stocks, and financials. And we continue to be underweight international equities, high volatility, and high yield debt. We don't necessarily see too much of that changing, with the exception maybe on the high yield debt side. Adding some high yield debt as we go through here, and making a few changes on the fixed income side, but most of this will probably stay pretty constant as we move forward. So, the elephant in the room, obviously the coronavirus, this is going to dictate everything from an economic and a market perspective as we move forward until we've got a vaccine in place. And from a data perspective, really what you're seeing is the number of cases. They spike up in the summer, they come back down. You're starting to see them move back up, and really, this is the thing that we'll be watching. But from the actual deaths from the coronavirus, has declined quite dramatically from what we saw in the spring, and that's a function of the amount of testing that's being done, and also the ability for us to be able to treat individuals that have it. And what we're going to be watching to see is do the number of cases really move back up as people are moving in for the winter. And in New York State, you're really seeing that in some counties where it's spiked back up, and they're having to kind of close things back down a little bit, which really impacts things from an economic perspective. And as I mentioned, it really comes down to, can we get a vaccine that's effective through the approval stages and out to full release to everybody? This is the crux of how quickly we're going to come back, along with effective treatments for those who have the virus. So really, this is something we'll be watching, and hopefully we'll continue to see positive news come out in this area. We talked about, what shape is the economic recovery going to be, and a V recovery basically is the sharp decline that we saw in March, and then a quick recovery. And this is looking at a number of different areas in the economy, and really, with the exception of mortgage applications, which is that top blue line that really does look more like a V, where it came down sharply and it's risen back up. Many of the other areas, probably, I guess, so the letter might be more like an L, where they've come down sharply and really been kind of flat or moving up fairly slowly. So again, these are the areas that we're watching to see, really what this means for the overall economy. And, without a doubt, when it comes to, from an economic and market perspective, what is the Federal Reserve and the federal government going to be doing? Because these really drive a lot of behavior and performance from a market perspective. And what you see with the Federal Reserve is, from 2009, they kept rates low. They started moving back up during the recovery, and they dropped them back down to close to zero right when the coronavirus hit. And they've come out and said that until 2023, they're going to be really close to zero. And all that means is that with low rates, equities look great. And, you're going to probably see people continue to take on more debt and be more inclined to be more, take on more risk from a portfolio perspective. And the other element with this is the Federal Reserve balance sheet, right? So, if the Fed's going to be out there buying bonds, which you can see they have been doing, they've been adding those to the balance sheet, that's going to really support bonds, and it's going to keep rates very low. So the Fed has come out and said they're going to continue to do this, and so our expectation is that rates will remain low for quite some time. The only variation from that is going to be inflation. So this blue line shows inflation over the last 50 to 60 years. And, it's been very low, below 2% since the mid-90s. And if inflation remains low, we saw from the Great Recession that the Fed's going to keep rates very low for as long as they can. With the, one exception is if inflation does start to rise above 2%, then that could change and the Fed might have to act. We talked about the importance of the stimulus and the federal government stepping in. This basically shows you a number of different areas from the service sector, manufacturing, and all of the declines that happened starting in March. And the green bars at the top are really the stimulus coming in place. So the federal government stimulus was over $2.2 trillion, and it really has helped buoy the economy in a number of different areas. I think really what is going to be so important, and the Fed has even come out and said that, is having a second stimulus come into play, and getting some sort of agreement between the administration and the House and the Senate. So we're going to be watching that closely, and that's going to be really important to move us through the winter months. And we've talked about this as well. That stimulus, it's going to be continuing to increase the federal debt, which is absolutely a problem from a long-term perspective. I think we're all in agreement from an economic perspective. It needs to happen. You need to provide that stimulus, but over time, we need to manage what that debt is. This is relative to the GDP, and the threshold that you can see that it hit back in 1948 was over 100%, and we're forecasted to do that over the next 10 years. I think the thing to stress here is short-term, probably not a problem. But long term, it's definitely going to be, it could be a problem for the economy and something that we're going to have to tackle at some point. And now we'll pass it on to David.
Thank you, Marty. And as Marty touched on, there's been a lot of letters thrown around regarding the shape of the recovery. And in our quarterly letter, we mentioned a new letter was added to the alphabet soup, and that was a K-shaped recovery. So if you could imagine, the initial drop is the left side of that K. And coming out of this pandemic, we have seen certain areas benefit from that pandemic, and then other areas be hurt more disproportionately than the others. And so that would form the right side of the K, the up and the down. One of the main areas that has benefited is any stock or company related to work from home. So as you can see here, it's the year-to-date chart of Zoom, DocuSign, CrowdStrike, and Twilio. Those are all cloud-based companies. Obviously, everybody's familiar with Zoom, and most people are probably familiar with DocuSign. And just their year-to-date performance, as investors have really tried to pile into what they view as the emerging trend that will continue for the foreseeable future. Now, this is one of the more surprising charts I think that has come out from this situation that we're in, and that is the retail sales not only getting back to where they were pre-COVID, but also exceeding them with the most recent reading. So as you can see, the consumer is strong, and we've mentioned this in prior communications that the consumer represents about 70% of the economy. So seeing retail sales at these levels means that people are going out spending money. It's just that they're doing it in different channels than they were before, whereas maybe before it was brick and mortar retailers, and as we'll show in some upcoming slides, that shift has really gone into the online marketplace. So as you can see here, the trend was already heading upwards for online sales as a percentage of retail sales. But as you can see, that spike happened in March/April, when a decent amount more of sales were done online. And one of the more surprising things about this chart is still looking at the percentage of total sales. We're still at about 15 to 17% of sales being done online. So there's still room for this to run. It's just that this may have gotten pushed into hyperdrive given the recent situation. This is a follow-up to something that we talked about last webinar, and that is the personal savings rates. Again, this is one of the more surprising things, and this is primarily due to two factors. One is the stimulus provided by the government, and also from the standpoint of there's not really many places other than online that you can really spend your money nowadays. Restaurants and some other areas are opening back up, but they're at limited capacity. So you're seeing historical numbers for people's savings rates in aggregate. So this is something to watch moving forward as as a vaccine gets developed, as things start to open up even more. We could see this money start to circulate throughout the economy, and that's going to be a big driver of growth and also potential inflation, depending on how quickly it moves through the economy. And housing numbers have been continuously good. As you can see, there was a drop immediately following the impact of COVID. But not only are new homes being built, but also existing homes are selling at record rates. I'm sure most people have some sort of anecdote of themselves or a friend that recently sold their house, and people are flocking away from the cities into the suburbs and into the country, and they're paying top dollar for those homes that are out there. So we're seeing a limited amount of supply and a growing amount of demand that is pushing the housing market forward. So just to recap, we've seen the online sales pick up the slack that the brick and mortar retailers have left behind. The housing market is strong. As a result of that flock from the city to the suburbs, the record low mortgage rates have a lot to do with that as well. So we'll see how that moves moving forward, especially if there is any sort of uptick in the mortgage rates. And then the consumer spending is stronger than ever, which again is a somewhat surprising development given the state of the general economy. But I think a lot of that ties back to the stimulus that was provided by the government, and maybe some future stimulus depending on the developments there. Now, unfortunately, there are areas of the economy and quite a few that have been impacted adversely from this pandemic. The first is a split between low-wage workers and high-wage workers. Here is defined as high-wage employment at above $60,000 per year, whereas low-wage employment of below $27,000 per year. So you can see there's a big difference where high-wage employment is almost back to where we started, whereas those who are lower-wage workers below $27,000 per year are still 16% below the numbers that we saw in February. And from a small business perspective too, of course, we've all seen the impacts locally on small businesses in the area, the restaurant industry. As you can see, the leisure and hospitality, which is that magenta line, has borne the brunt of this more so than other small businesses. But I think it's safe to say that small businesses in general are feeling this impact much more than the large companies that we're familiar with, like the Amazons and Microsofts and things like that. This is a pretty stark description of how far the airline industry has to go to make up any lost ground. The line on top is the total traveler throughput of a year ago today, and then the line on the bottom is what we're seeing today. So essentially that's how many people are checking through TSA on a daily basis. As you can see, there's a spread of roughly 1.5 million or more on a day-to-day basis that we have to get back to where we were before as far as air travel goes. So the airline industry still has a long way to go. I know they're trying to wrap up the airline program into the overall stimulus bill that hopefully will be passed in the next couple of weeks. But we'll see where that goes. As people become more comfortable with flying, we'll see these numbers pick up. But unfortunately, right now, we're seeing it kind of flatten off from the initial drop. And then hotel capacity, or hotel occupancy, I should say. You can see during a normal recession, quote unquote normal, like 2009, there is a drop off from what we would normally expect in hotel occupancy. But given the nature of this situation, we are seeing a dramatic decline in the amount of rooms that are occupied in hotels. So tying it back to a prior chart, the hotel, leisure, hospitality, that industry is feeling the impacts of this much more so than other areas where they might be able to pick up the slack by offering some online offerings. You obviously can't do an online offering of a hotel room. So again, this, along with the airline industry, I'd say are the two areas that are being impacted the most during this pandemic. And just to visualize the industry and sector performance year to date, you can see the split and the dichotomy between the airlines, energy, hotels, resorts, and cruise lines. And then on the left, we're seeing the online retail, home improvement. That ties into the housing market. And I think anybody who's been to a Home Depot or a Lowe's on a Saturday can attest. The amount of sales that they're doing is incredible as people are working to improve the place where they've been stuck for the last 6 months. So we're definitely seeing a major split in the economy and who's benefiting from this and who's not. So just to recap, it is disproportionately affecting different demographics and business segments. And there's still a lot of repair needed in the labor market as we start to put people back to work. Moving forward, we'll see how that plays out. And now I'm going to bring it to Ryan, who's going to talk a little bit about how this affects the portfolios.
All right. Thank you, David. Yeah, I'm going to go through our portfolio perspective. There's 4 key areas I want to focus on today. And these are really the talking points that have been coming up the most with our client discussions. And those 4 areas are the election coming up. That's only about a month away now. This concept of a disconnect between Wall Street and Main Street. 3, I want to talk about unemployment trends. David touched upon it a little bit, but I want to expound on it just a little bit here. And lastly, which was from a great question from a client, was about the 60-40 portfolio and this notion that is it dead going forward given where interest rates are. So I'm going to talk about all 4 as we wrap up the presentation. So the upcoming election, and we've talked about this a little bit, even going back to our State of the Economy earlier this year. And I'm sure we're talking a lot about it if you've had planning conversations or general calls as clients. So this chart goes back about 90 years, let's say. And for the last 82 years or so, there's a common theme and trend, no matter if it's a Democratic president, Republican president, and that trend is up. And so a lot of what our stance is right now and what we've been talking to clients about is that, we really have to make decisions for the long term. Now, politics are passionate. And, there is a lot at stake with this upcoming election. So I don't want to diminish that by any means. I mean, you think about, if Biden wins the presidency and the Senate flips potentially to Democratic, you could see, maybe more Supreme Court justices has been talked about, addition of different territories like Washington, D.C. or Puerto Rico, which could increase the electoral college votes. The one major idea and area that I think is a concern is tax rates, both for corporations and personal tax rates. And so there's a lot to be concerned with and a lot to follow and see how it plays out. But from a long-term perspective, we really don't think any of these are going to have a major impact. You may see some short-term volatility, and that's always the case, no matter election year or not. But I think overall, it's really going to be dictated by the economy. And tax rates on corporations has never made a huge impact, again, long-term on how these corporations do. They're resilient. They'll get through it. If we get some increased tax rates on individuals, it seems like it'll be more on high net worth earners. Again, maybe a small impact, but I don't think enough to really derail both the economy and the stock market. This is just a great chart. This goes back 120 years. You can see on the left side, if you started with $10,000 back in 1900, if you invested it just during Republican presidencies, that would grow to $100,000, give or take. If you just invested it to Democratic presidencies, about $430,000. If you stayed invested that entire time, you're over $4 million. I think the big takeaway here is the longer you're invested, you get compounding working on your side, it's going to work out. Again, I know politics can be passionate, but try not to get, from an investment standpoint, too emotional over it. And again, if there's anything specific you want to talk about, please give our office a call and we can talk through some of the pros and cons of what's going on throughout the election. The second main area I wanted to cover today is that disconnect or perceived disconnect between Wall Street and Main Street. And, it's hard to predict what's going to happen in the future, but if we can take a step back and look over the last 7 to 8 months, a lot of what has happened, you can make that connection between Wall Street and Main Street. David talked about it a little bit in his section, but here we're going to look at the gray line is the top 10 companies in the S&P 500. The green line is the top 5 companies. So the top 5 right now are Facebook, Amazon, Apple, Microsoft, and Google. And what percentage they make of the overall S&P 500. Right now, it's a very, very high percent. It is very top weighted in the S&P 500. And it just so happened that these companies were the best to handle what COVID and the coronavirus brought to us. They were all good companies, well equipped to handle this sort of new normal we're dealing with in the immediate future. And they've continued to do well. If you look historically, just over the last 25 years or so, it's only been about 7% of the overall stocks that have carried the stock market forward, believe it or not. So it's not uncommon for very few firms and very few companies to carry the gains within a major index, even one like the S&P 500. Now, when you think about how well these tech companies have been doing, is there any concern of, a tech bubble similar to 99 or 2000? And, in this chart, you see the gray line is the weight of these technology companies in the overall S&P 500. So how much they make up of the entire index. And that's been rising. You see the big jump around 99. The green line is at earnings per share. And in 99 and 2000, there was a huge disconnect between the weight of technology companies and how much they were earning. And earnings are the foundation of how to price these stocks and what the stock market is built upon. There's about a 20% delta there. So a huge, huge separation. Right now, earnings and the weight of these companies are really falling relatively in line. There's a little bit of a disconnect, under 5%. But what it goes to show is that these companies are valued pretty much in line with where they should be. Maybe a slight overvalue, but these are great companies. They're making a lot of money, and they should be the ones driving the market up because, again, they're doing well, and their earnings show that. We've used this graph before, and I'm not going to spend a lot of time on it, but it's more for the visual. We used this, I think, at our 2019 State of the Economy. The big takeaway, though, is the stock market isn't necessarily the economy. And the blue section is the stock market, the yellow is the economy, the green is the correlation. And they are mostly correlated. But where you do get some disconnects, and what we're maybe seeing now is around peaks and troughs, you do get a slight disconnect. usually about a 10 to 12 month disconnect between the stock market and the economy where they're not tightly correlated. So again, it's not uncommon to see a little bit of a disconnect between both the stock market and the economy. And so when you think about Main Street versus Wall Street, it's not uncommon to see that happening. And lastly, again, David talked about this a little bit in terms of what's kept up. Now, this is on the aggregate. So obviously, when we're looking at data from a high level, it's aggregated data. It does not take into account everyone's specific circumstance. And there's a lot of people that are hurting these days. But given the Fed's stimulation earlier this year, you see the trend from 2019 into 2020. People's disposable personal income has gone up. That's the reason why spending is up. That's the reason why savings rates are up. Now, market income has been impacted a little bit more negatively with your stocks or assets, maybe home prices, whatever it may be. They were impacted. They're still growing, but disposable income had a pretty sharp increase when the Fed stepped in, and that has helped the consumer greatly through this time. And so again, when you look back and what has happened, you can see all these things have worked together. And with those numbers, it makes sense where the stock market is and where it's been since the start of this crisis. Now let's talk about the unemployment trends. And right now, they're not great. The pink line is our actual unemployment rate. So the unemployment rate for September just came out at 7.9%. So that's what that's showing. The blue line is the broader measure of underutilization. So this may be folks who are working part-time because of economic reasons, or still kind of in between, maybe temporarily laid off. That number is a little bit higher. I'm guessing the true unemployment rate is somewhere in the middle there, but we're seeing it was coming down a little bit more sharply back in April. We're seeing that kind of flatten out, and we'll continue to see how that changes as time goes on. We had a lot of, David pointed out, low-income wage earners bearing the brunt of it early on, but we're seeing more high-income earners losing jobs or temporary layoffs becoming permanent. This is what this chart is showing right here. The light blue line was the job losses, permanent job losses from 2001 during the tech crisis. The dark blue line is 2007, the financial crisis, and this red line is our current COVID crisis. And when you look at the permanent job losses, we're actually losing permanent jobs faster than we did. Now, this is a much different scenario and outside force than what the fundamental economy was dealing with in 2007 or the markets were dealing with in 2001. But we're going to look at this trend line very closely as time goes on, because as more permanent jobs are being lost and it's being impacted on higher income earners, that could cause some structural damage to the overall economy, which was very strong before pre-COVID, let's say back in January and February. And the last topic I want to touch upon today is the idea or the question of the 60-40 portfolio being dead. And this came from a question from a client, but it's a theme and a topic that has come up often with our conversations with clients. And so, do bonds still offer a purpose? And this chart in red is showing the aggregate bond index. And I ran this yesterday and it was just perfect. So the red is the aggregate bond index, or the US bond index year to date. The blue line is the S&P 500 year to date. They're both essentially at the same point, but those paths obviously look a lot different. So what do bonds offer? Well, one, diversification. We've talked about that in the past. In any investment book, typically bonds and equities kind of can move in different directions in different times and peaks of volatility or good times. Two, stability. I think this chart shows stability more than anything. But three, where I think bonds really play into, is your behavioral approach to investing. And think about it. If you were in 100% equity allocation at the start of this year, let's say it's $1 million portfolio, from peak to trough, that $1 million would have gone down to almost $600,000. You would have lost close to 40% of the value there. Even though you're long-term, stocks are going to go up more than probably bonds long-term, going through a period like that could be devastating. And what could be even worse is towards the bottom, you just couldn't take any more losses and you sell out. If you sell out at the bottom and you miss that quick, sharp rise in stocks, that's where your long-term, retirement goals, financial goals can be impacted the most. So even if you hold bonds to get you through a time like that where you don't sell out and you stay the course, that can do wonders. You might not be able to measure it, with exact numbers or detail, but from a long-term investment perspective, it makes a world of difference. And lastly, talking about the 60/40 portfolio, all bonds are made a little bit differently. And, see in this chart, high yield corporates, preferred securities, emerging markets, investment grade, all the way to international bonds and muni bonds. There's all different flavors in the bond market. And what we've been talking about over the last couple of weeks is adding some diversification to our overall bond mix and also looking to alternative investments. There's different ways. And again, you may see this as part of your overall allocation in the coming weeks or coming months. We're going to probably make some changes, nothing major right now because we're very comfortable with how we're allocated in the fixed income space, but we need to kind of rethink it maybe a little bit in this current low interest rate environment. And so just to briefly recap, right now the election shouldn't alter your long-term investment goals. The market has acted rationally in hindsight over the last 7 or 8 months, even though the future is still so hard to predict. Unemployment trends concerning to foundation of overall economy right now. And in our minds, the 60/40 portfolio isn't necessarily dead, but we may need to reimagine it a little bit. And it's also a good time to evaluate your tolerance for risk. And given kind of what's going on with interest rates, could you take on potentially more risk from an equity side? And we can talk about the pros and cons of that. And if you'd like to talk to an advisor, again, please give our offices a call. Here are disclosures. If you do have any follow-up questions, we're going to try to post this evening and get this out to you. So we'll have the slides and the presentation. I did see a couple questions come through the presentation app. I'm unable to answer them right now, but please, again, if you do have specific questions, give our office a call. We're happy to answer them. Again, thank you for joining us today. We really appreciate it, and have a great rest of your day and have a wonderful weekend. Thank you.